In month 11, and then on the anniversary every year thereafter, you're going to focus on building out a short list of potential acquirers for your client's business. Now, why would you want to have a short list? Well, what's important about a short list is that your customer, your client, starts to think about their business as an asset that would be attractive to buyers. And then once they've got that lens on it, they're starting to wear that hat as owning a business that they're trying to make as attractive as possible to acquirers. Once they know who those potential natural acquirers are, they can start to look at decision making in their business differently. They can start to think about their decisions, strategic decisions they make, hiring a certain type of person or starting a second office in a certain area, etc. They can start to look at those decisions through the lens of how an acquirer, their natural acquirers, would view those decisions, whether it would make them more or less attractive to those natural acquirers. Now, there are a lot of reasons that big companies buy little ones, and in particular, the highest multiples, the highest prices are paid for businesses where there is a strategic acquisition involved, where there is some strategic reason that the acquirer wants to buy the business. And strategic acquisitions are defined as a situation where the acquiring company has some sort of asset that makes the business worth more to that acquiring company than it would be as an independent operating business selling to, for example, a financial buyer. There's got to be some asset or resource that the strategic is going to bring to bear to make it worth more to them than it is naturally in the marketplace. Good example of a strategic acquisition, and I'm going to walk you through a couple of examples now, would be Microsoft's acquisition of Skype. Microsoft is the world leading operating platform where with the Windows software platform, they have a massive market share. The problem with that is that most of the Windows users are not using Windows 8. Windows 8 only represents less than 7% of the Microsoft Windows installations out of the marketplace. About half of Windows users are still on Windows 7. A quarter, if you can believe it, are still on Windows XP. And so what Microsoft's big challenge is not necessarily to find new customers to be introducing them to Microsoft. It is, of course, to get people to upgrade from, in particular, XP and also, to a lesser extent, Windows 7, to get them up into 8 and something more modern. And when they looked at Skype, it's my belief that they said this is a possible way to get people to migrate, in particular in the developing world, where Skype is a dominant communications platform. If they could get those folks through a slick integration of the Skype user platform into a newer version of Microsoft Windows, they would be able to monetize a very large acquisition. And in the case of Skype, Microsoft bought them for $8.5 billion, but with a B, even though Skype was losing money at the time. Why? Because they saw an opportunity, I believe, to start to migrate some of their legacy customers onto more modern versions of their various platforms. So that's one reason that a company might buy another company, because by acquiring them, they would make an existing product or service more attractive. In the case of Microsoft, it was the Microsoft Office and Windows platforms that they thought that you could make more attractive by buying Skype. Rosetta Stone bought a European language company. They bought them for $28 million. Why did they do that? Well, Rosetta Stone has great market share in North America and some of the other markets around the world, but we're not really dominating as well as they usually do in Europe. Their acquisition, Tell Me More, was a company that they acquired because they were doing very well in Europe. So sometimes acquisitions are geographically motivated, where company A buys company B for better access to a geographic market. Sometimes companies buy other companies to control their supplier resources better, to control their supply and their supply chain better, which is why Starbucks bought Evolution for $30 million recently. Evolution was the maker of those great natural fruit juices and so forth, and Starbucks wanted to have more control over that supply chain and therefore purchased that company as opposed to buying from them as a supplier. Another reason that big companies buy smaller companies is that they want to give some more things to their salespeople to sell. You know, when a big company has lots of salespeople, that becomes an incredibly expensive resource for them to try to monetize. Salespeople generally, in particular enterprise salespeople, are expensive to hire, they're expensive to keep, expensive to retain, motivate, etc., train. And so once you've done all those things, once you've built a very large sales force, it's part of the job is to make sure they've got enough things in their briefcase to sell. So what AOL did was when they acquired the Huffington Post, what they were trying to buy was more inventory for their salespeople to sell. AOL represents a variety of websites around the world. What those salespeople are good and savvy and well-trained and know all there is to know about search engine marketing and so forth and marketing online, but what they needed was more inventory. And at the time, the Huffington Post was driving 30 million unique users per month, and AOL reasoned that if they were to be able to put those users into the briefcase of their salespeople, they would be able to monetize that investment carefully, or considerably. So sometimes big companies with a large sales force will buy businesses to put another thing in the briefcase of that sales team. Google bought Frommer's, and why did they do that? It's interesting. Frommer's, the traditional guide series, the travel guide series, had tremendous search engine optimization rankings because they'd written so many articles and had so much published in the internet sphere. Google wanted to get into the travel space and wanted to own all the natural organic searches that happen, or the majority of those natural organic searches that happen. And at the time, Frommer's was beating them. Even though they owned the search platform, they were beating them on many of the different searches from a travel perspective. And so Google bought Frommer's. Interestingly, as a postscript to this story, they sold the actual guidebook business back to the original founder of Frommer's, the physical books that get published. What they were interested in buying Frommer's for $22 million was the Google juice, the search engine optimization juice that came from all those online articles. Herman Miller bought POSH. Herman Miller, the makers of the Aeron chair and the very fancy office equipment manufacturer, very large physical presence here in North America. However, not much of a presence in mainland China. So when Herman Miller bought POSH, POSH had 50 different dealers all around mainland China that sold their furniture. Herman Miller saw POSH as a way to enter the Chinese market for office space, the fastest growing office space market in the world. And so for Herman Miller, it was a geographic play, a way to get access to a new and different market. So again, there are a variety of reasons that a big company would buy a little one, and the strategically motivated reasons are going to garner the best price for your client's business. Now, the final thing I want to show you in this video is the 5 to 20 rule. And the 5 to 20 rule states that the natural acquirer for your client's business is going to be between 5 on the low end and 20 on the high end times the size of your client's business. Between 5 and 20 times the size of your client's business. Now, are there exceptions to this rule? Absolutely. We could all list many. But I think you'll find that over time, if you study this enough and you look at enough examples, you'll find that more often than not, the acquiring company is between 5 and 20 times the size of the acquisition target. Well, why would that be? Well, let me give you a scenario. Let's imagine for a second you're a company generating $100 million of revenue. And you, like most big companies, have a mandate from your board of directors to grow that business by 15% each year on the top line. So that's the board of directors' expectation of you, to grow that business by 15%. Or for a $100 million company, that would be going out and finding $15 million in revenue. Now, most big $100 million companies are pretty mature. They don't have a lot of fast-growing parts to them anymore, so they've got some maturity involved. That's a good thing, but it's also a bad thing. It's hard to grow very quickly. And so organically, this $100 million company might be able to come up with 5% organic growth. And if you look at the example on the left-hand side in the green text, you can see that that equates to about $5 million of new revenue for this company just by organic sources, cross-selling, increasing prices to existing customers, etc. And therefore, in order to go out and grow this business by the board of directors mandated to 15%, it's got to acquire a $10 million business. And by acquiring a $10 million business, they add $10 million in total revenue, plus the $5 million they got through an organic growth. And bingo, they get their $15 million of lift. Now notice that the $10 million acquisition fits nicely within the 5 to 20 rule. It's 10 times the size, or it's 1/10 the size of the acquiring company. So it sits nicely in the 5 to 20 rule. Option B in the red text is another scenario that the CEO of this $100 million company could envision. But in order to pick up, in this case, they're looking at an acquisition of just $2 million. And so now they've got a problem because they're only going to pick up $2 million of new revenue. That means they've got to find 13% or $13 million of organic revenue. Well, again, finding $13 million on a $100 million company is going to be very challenging for most businesses just because they're mature businesses and you just can't squeeze that much juice out of a lemon. And so you find that the acquisition candidate has to be larger. And so, again, using this example, the example on in the red on the right-hand side of your screen does not meet the 5 to 20 rule. It's only a $2 million business. The acquiring company is a $100 million business. So it doesn't meet the 5 to 20 rule. So even though they could acquire it with their eyes closed, it wouldn't give them enough lift in order to generate the kinds of growth expectations their board of director has. So again, that's why the 5 to 20 rule it tends to play out in the M&A world, because when you've got a mandate to grow, there's only so much growth you can get through organic sources. And in order to top that up, you need to acquire companies of a size that give you enough girth, if you will, to make an impact.